Morning everyone, welcome to End of Week Ainsley News. It's Friday the 4th of February. Today we're talking inventories and the hidden death knell. Yesterday we talked of the very high likelihood the US Fed will be tightening into an already peaking economy and the cyclical resonance effect being potentially very bad for markets. It's a must listen to if you missed it, and it's a precursor to today's part 2 piece delving into Julian Brigden's latest insights. Today we look at the role of inventories in these cycles. We'd venture that not one listener has not been affected by inventory effects since COVID, but few would realise their causation in the economy. Former US Fed Governor and still prominent economist Alan Blinder says the business cycle, to a surprisingly large degree, is an inventory cycle. Yesterday we talked of Brigden's great moderation and the smooth and disinflationary economy since the fall of the Berlin Wall and globalisation of trade and manufacturing. New World advocates try to dismiss manufacturing as an important economic metric in an increasingly digital world. But the chart we show today, jump over to ainsleyBullion.com.au and check out the news there, all the charts, it clearly illustrates the tight correlation of the economy and manufacturing, the relative calm during the Great Moderation period, and the scale of the disruption since COVID. It's important to note that manufacturing is heavily influenced by inventory swings. Part of what smoothed out the ISM above, or shown in these charts, is the shift to just-in-time supply chains. Logistics and transport both get more efficient and effective, and business didn't need to hold much inventory but still meet the needs of its customers. What COVID and China tensions demonstrated, and indeed are still demonstrating, is that just-in-time, or JIT, can break in painful ways when one or more pieces of that finely tuned supply chain fail. And so we have seen companies around the move from just-in-time to just-in-case inventory management. As Brigden explains, definitionally, this requires enterprises to hold larger precautionary inventories, essentially reversing many of the gains of modern inventory control and leaving them exposed to the sort of inventory and production swings we saw before the 1990s. If that wasn't enough, the pandemic has accentuated risk because it has created a massive divergence between manufacturers' inventories and those of their customers. Part of what causes this massive divergence is two reasons on the manufacturing side. Firstly, manufacturers have been over-ordering to build up precautionary inventories and potentially front-running inflation for them. And secondly, producing as much as they can but missing key components like silicon chips. And so, unfinished but largely complete, cue the images of football fields of F-150 trucks waiting for a single CPU. On the inventory side, we have empty shelves, car yards waiting for these stalled goods. The head of ISM Manufacturing, which gives us all these insights, just warned it will take 3 to 4 months worth of heavy output here to burn off the backlog and fill the shelves. And so piecing together yesterday's article and news and this potential surge of inventories, you can see yet another pro-cyclical alignment like the Tacoma Bridge analogy we discussed yesterday. But imagine a scenario where just as we finished filling these shelves, demand dropped sharply because the Fed had over-tightened and tipped over equities. Could we rapidly flip back from a backdrop of inventory famine to inventory feast just as demand weakened? Could this drive customer inventory to a peak just as the headlined ISM index drops, thereby generating a recession and forcing the Fed to reverse policy back again the other way? That may not be how things play out, but the stars do seem to be aligning. Overordering has a long history. To illustrate the power of the inventory cycle, it's worth looking at another historical analogy. In the book Hand-to-Mouth Buying and the Inventory Situation, George Gade describes how at the end of World War I, pent-up demand, together with the end of wage and price controls, led to a surging economy. The result was that manufacturers massively overordered to try to get ahead of inflation. Unfortunately, this left them dangerously exposed. When the equity market started to roll over in late 1919, ultimately falling 45%, the ensuing slowdown left them with an inventory overhang. The result was a collapse in production and a particularly severe recession. COVID was just an accelerant. Even before COVID, the structural factors that underpinned the Great Moderation were reversing and, given time, would have resulted in a greater economic cyclicality. In that sense, COVID-19 was merely a catalyst, albeit a remarkably effective one. That has not only left us with a massively overvalued risk market and an unusually vulnerable setup in inventories, but also a Fed that is just waking up to how far they are behind the curve. When combined with hyper-financialization, which ensures the instant transmission of a fall of asset prices straight into the economy, we have the ideal setup for a policy error and a sudden economic slowdown, practically the definition of market volatility. Overnight, we saw US factory orders for January fall the most since April 2020, in the meat of the COVID crash, and earlier this week, both markets and ISM's manufacturing indexes fell again. And if you missed it, last week, the Atlanta Fed's GDP NOW, or GDP Now forecast, typically the best at getting it right and part of the very same US Fed steering this ship, revised its Q1 economic growth forecast to just 0.1%. So just to recap, we have sky-high inflation forcing the Fed's hand to raise rates. We have clear signs of an economy having peaked and weakening, which equals stagflation, a tsunami of inventories on their way, but not quickly, a hyper-financialized economy that reacts immediately to the share market, and a share market that is correcting sharply on just the expectations of tighter trade. And so a Fed with the win-free choice of hiking too late and into weakness and crashing the entire market by default, the global economy will do nothing and allow inflation to run wild, both financial assets and the general economy, delaying but exacerbating the inevitable. And yet, gold hovers around US $1,800 without Joe Public seeing the for sale sign on it. Fascinating news there for today's insight. Hope you've enjoyed it. Jump over to ainsleyBullion.com.au for all things gold, silver and platinum. Also, all our charts for our news. AinsleyWealth.com.au for all things cryptocurrency. Check out our new dashboard there. You can see some great insight. Help make better purchasing or better sales. And goldsilverstandard.com. That's our own cryptocurrency, built and backed by real gold and silver. Enjoy your weekend, and we'll catch you next week for more news.